In the 1970s, bank loan officers in Iowa and Nebraska drove up and down rural roads in their cars, not because they were lost. They were looking for farmers. They knocked on farmhouse doors. They sat at kitchen tables. They told men with calloused hands that the good times were here to stay, that land values would keep rising, that the export market was permanent, that borrowing was the smart move. Could you use more credit? They asked. Most farmers said yes. Why wouldn't they? The bank was offering. The government was encouraging it. The numbers at the time made sense. Then the numbers stopped making sense. And those same banks, the ones that had driven down those same roads, looking for people to lend to, came back with different paperwork. This time they weren't offering credit. They were taking land, and some of them already knew exactly what they were going to do with it. The banker who knocked on doors. Iowa, 1970-1983. Pat Meade was a farmer from Milo, Iowa. Years later, he remembered something that stayed with him about the 1970s. During the 1970s, he said, there were times when lenders quite literally drove up and down the road, knocked on people's doors, and asked them if they could use more credit. He wasn't describing a single incident. He was describing standard practice. Banks were flush with money in the 1970s. Land values were climbing. Grain prices were high. Lending to farmers was considered one of the safest investments a bank could make. So they pushed the product. A farmer who went to the bank and asked for a loan was one thing. A banker who showed up at your door and told you the money was there waiting for you, that was a different kind of pressure. By 1984, the Federal Reserve Board estimated that 1/3 of all American farmers held nearly 2/3 of the nation's total farm debt. Much of that debt had been actively sold to them by institutions that would later foreclose on it. When the prices fell and the foreclosure notices went out, those same bankers did not drive back down those same roads to apologize for the advice they'd given at kitchen tables a decade before. The Quota system. Farmers' Home Administration, 1981 to 1985. In 1981, Ronald Reagan's budget director was a man named David Stockman. Stockman had a problem. The federal deficit was too large. He needed to cut spending, and the Farmers' Home Administration, the government's farm lending agency, had billions of dollars in delinquent loans on its books. Those loans were farmers behind on payments. Stockman's solution was to treat them like a budget line item. Under his direction, FMHA began what was officially described as an aggressive campaign of reducing delinquencies. In plain language, foreclosing on farmers to clean up the balance sheet. County-level FMHA offices were given quotas, not guidance, quotas, numbers of delinquent accounts to be resolved. To hit those numbers, loan officers across the Midwest began accelerating loans, telling farmers that debts they thought they had decades to repay had to be paid in full in 15 or 30 days. Farmers were given to options: voluntarily liquidate, meaning sell everything and leave, or be shut down. If they chose neither, the agency seized their income from crop and milk sales, emptied their supervised bank accounts, left nothing for living expenses, nothing for feed for their livestock. The quota system was not designed to help farmers recover. It was designed to move numbers off a government spreadsheet as fast as possible. The land those farmers had worked went into federal inventory, and from there, into new hands. The insurance company that never left, Manulife John Hancock, 1980 is present. While farmers were losing their land, and banks were failing across the Midwest, someone else was paying attention. A Canadian insurance company called Manulife, known in the United States as John Hancock, started buying American farmland during the 1980s crisis. Not a farm here and there, systematically, at prices the crisis had made a fraction of what the land was worth. In better times, Iowa farmland had lost 62% of its value between 1982 and 1987. For a large institutional buyer with patient capital and a long time horizon, that wasn't a crisis. That was an opportunity. Manulife bought and kept buying year after year after year. Other institutions followed: pension funds, sovereign wealth funds, insurance companies from Sweden, Canada, the United Kingdom. The farmland that had been in American family hands for generations, the land the crisis had pried loose, moved into institutional portfolios, managed from office towers, in cities where no one had ever watched a crop come in. The 1980s farm crisis did not just destroy family farms, it transferred them from the families who had worked them to the investors who saw the floor and moved in while others were still falling. The farm credit system collapse. Springfield, Illinois, 1985 to 1987. The farm credit system was established in 1916. For nearly 70 years, it had been the backbone of agricultural lending in America, a network of cooperatively owned banks, specifically designed to serve farmers. In 1985, it reported the largest financial loss in its history, the first losses since the Great Depression. The farm credit system had done what every other lender had done, lent aggressively on land values that were now in free fall. By 1986, the system was technically insolvent. Congress passed the Agricultural Credit Act of 1987 and provided a $4 billion bailout to keep it from collapsing entirely. But in the years between the losses and the bailout, the farm credit system's local banks had been foreclosing on the same farmer members who technically owned them. The cooperative structure that was supposed to mean the lenders and the borrowers were the same people had broken down completely. Farmers were foreclosing on farmers. The institution built for agriculture was dismantling it to save its own balance sheet. And when Congress finally stepped in with the money to stop the bleeding, the farmers who had already lost their land did not get it back. The land that never came back. The American Midwest, 1985 present. By the end of the 1980s, an estimated 300,000 farms had defaulted on their loans. Iowa lost 24% of its farmers. The land didn't disappear. It consolidated. The farms that were foreclosed on were purchased by neighbors who had survived, by investors who had waited, by institutions that had been watching. From the moment the floor started giving way, Manulife started buying American farmland during the 1980s, in the direct aftermath of the crisis, and never stopped. Today, the largest private farmland owner in America is not a farmer. It is Bill Gates, who through his investment firm now owns an estimated 275,000 acres of American farmland across 18 states. His holdings are managed by a subsidiary called Cottonwood AG Management. He did not build that position by farming. He built it by buying land that had been in family hands until the families could no longer hold it. The crisis that the banks helped create by pushing credit on farmers in the 1970s and accelerating foreclosures in the 1980s produced the largest transfer of American farmland ownership since the Homestead Act of 1862. The family farm did not end because families stopped wanting to farm. It ended because the institutions that held their debt moved faster than they could. More than 1,600 banks were closed. Between 1980 and 1994, 300,000 farms defaulted on their loans. Iowa lost nearly a quarter of its farmers. In a single decade, the banks that survived did so partly on the land they had foreclosed on. The institutions that moved in during the crisis are still there, still buying, still consolidating, still managing the farmland that used to have family names on the mailboxes. The men who drove down those Iowa roads in the 1970s, offering credit to anyone who would take it. They were not villains in a movie. They were doing what banks do. They were following money. The tragedy is that the farmers who opened their doors were following something else entirely. They were following the same thing they had always followed. The belief that if you worked the land honestly, the land would hold you. The banks knew better, and they came back for it anyway. New stories every week on Deep Furrow.